Okay, hi everybody, and thank you to all the board members out there that have taken your valuable time to be here today. You're going to get a lot of good information. You know, about 3 years ago, when David Zapponi came up with a great idea to ask the insurance expert, I was the first speaker, and I asked him, "How long do I have to talk, Dave? 20 minutes?" He goes, "No, how about an hour, Kevin?" And I remember I freaked out. I'm like, "Oh my gosh, do I really know enough about insurance to talk about it for an hour?" Somehow we got through with it though, and it was great. So I'm really happy today to be able to share the virtual platform with 3 other professional and very competent insurance professionals that specialize at homeowner associations. One caveat before I begin, I'm dealing with a little bit of a respiratory illness, so I might be coughing a little bit during my talk, so I apologize up front for that. Okay, I think we have a lot to cover today. So Connor, next slide. Oh yeah, we've all felt the pain this year, right? A lot of us, especially if you're in the high wildfire zone, if you got non-renewed. So I just wanted to share that with you to know that we know what kind of pain you have, and we also are suffering from it on the insurance side as well. Okay, next slide. Thank you. So what happens around the globe impacts local homeowner associations in Northern and Southern California, Central Valley. And that is because catastrophes have been the primary reason that the insurance rates have gone up. As we'll see in a little bit, there are other primary causes as well, but the number one cause overall is natural catastrophes. And there's something called reinsurance companies that provide capital to the standard market. So if you're a Farmers, a State Farm, a Travelers, a Philadelphia Insurance Company, you depend on getting capital from around the world. Well, if there's a catastrophe in the Philippines or in Britain, that means that the capital available to the US market is limited. So I wanted to start off with this Kevin in outer space picture to let you know that we have to look outside the box and outside California to really understand what's happening. Okay, next slide. So what I call a perfect storm. Over the years, last 20 years, I've been in Asia for 25. I've never seen such dramatic increases in our prices, unfortunately. And it's not only homeowner associations. As many of us know, it's our single family homes, it's our auto insurance, and it's commercial property insurance as well across different industries. So why is it happening? Well, number one, the catastrophes. Like I mentioned, they're the primary cause. They've been enormous all over the globe, and especially even in the United States. Secondly, when you have a lot of catastrophes, tornadoes, hurricanes, floods, hailstorms, severe snowstorms, convective storms, you're going to see construction inflation rise, which it has. That means the insurance companies have to spend even more money when a catastrophe hits. And then we all know about the California wildfires, how long it took to repair those homes and how much that expense was. But, you know, very few of us actually think about the high cost of vehicle repairs. We know it, but that actually impacts how much you're paying as homeowner associations, because many of the same insurance companies that insure your homeowner association actually write auto insurance. So for example, I remember 10 years ago, if you had a dent in your fender, it would cost maybe $500 to repair. Today, it's more like $1,500. And that's another reason. I read something last week when I was doing some research for my talk today, that the average American car, well, the average car sold in America today has over 400 microchips in it, each one over $1,500. That's amazing. And they say if it's a hybrid or if it's an electric car, you're looking at about 700 microchips. So the high cost of vehicle repair is another factor in driving insurance rates up. And then there's what the insurance company's term is called social inflation. How often have you seen personal injury attorneys fishing for customers on TV, on radio, in print, on billboards? Sure, some of these claims are legitimate and you need a good attorney to defend you, no doubt. But a lot of them are being frivolous. And that's also raising all the insurance rates for all of us. About a decade ago, the average personal injury lawsuit, according to the American Property and Casualty Association, the average payout was about $26,000. Today, the average payout is over $120,000. That's huge. And then older buildings across the California and across the United States, especially in our Bay Area, you have a lot of galvanized pipes and you have a lot of electrical panels that are beginning to fail. That also causes more claims, which means the insurance companies are paying out more. And then there's a high cost of reinsurance. Like I mentioned a minute ago, the reinsurance companies One in particular called Munich Re. It's the largest reinsurance company in the world. If an insurance company like Farmers or Travelers were to take in $100 of premium from their customer, they'll give about $20 to Munich Re. In exchange for that, Munich Re will step in and pay part of the claim when it happens. Well, January 2023, Munich Re renegotiated their terms. They said, we still want, we want about $20 on every $100 you collect, but we're only going to pay about $15 if there's a claim. And the primary insurance companies had nowhere to go. They had to take those terms because they've been paying out so much money and they've been losing money in the last couple of years. So I call it the perfect storm. These all come together. If one or two of these events and catastrophes happened, a few times, we wouldn't be in such a pickle. But today we are. Okay, next slide. I love this graph because it really drives home the point of how many claims we've had in the last 10 years. So what you're looking at here on this graph is how many separate claims, separate catastrophes were over $1 billion. And if you go back, you look at the average at the very bottom of the graph, it was only about $7 to $8 billion a year. That was your average. Then in 2011, it jumped up to about $19 or $18 billion. In 2021, it jumped up to about $20 billion. 2020, $23 billion. Well, take a look at the very top of the graph. 2023, all of a sudden last year we had a horrendous year. And as you'll see in a minute, 2022 wasn't much better. Okay, thank you, Connor. Next slide. So to give you an example, about a year and a half ago, we had Hurricane Ian. It touched down about 3 o'clock in the morning with high tides in Florida. It was a Category 5 hurricane, 150-mile-an-hour winds, 162 fatalities. This particular hurricane was the third largest in U.S. history, behind only Hurricane Sandy and Hurricane Katrina. And it happened at the end of 2022. And guess who has to write the check to repair all this damage for $74 billion? Well, the insurance companies do. So thank you, Connor. Next slide. So if Hurricane Ian wasn't too bad, 2 months later, a smaller hurricane, only $1.6 billion, happened 2 months later. It also happened to touch down about 3 o'clock in the morning and caused a tremendous amount of devastation for which the insurance companies had to write the check. Okay, next slide. So obviously, construction inflation has gone up. We talked about that already. Next slide, Connor. I have to keep it moving for speed here, everybody. It's a great time to be a carpenter or a plumber or heating and air conditioning installer because these guys are making good money, and women too in the industry today. Okay, next slide, Connor. So the insurance companies have been behaving badly. They're non-renewing a lot of associations if you're in a high wildfire zone, or if you have multiple claims. They want more money today. A hard market means that their appetite has shrunk. They're not willing to go after as many businesses as they used to, many associations. And today they want to see an increase in the price. Next slide. So what a lot of companies are doing today is they're taking some very painful actions. They're laying off their workforce. They're cutting their agents' commissions. I can tell you, I've been eating a lot more peanut butter sandwiches than I like to these days. And the insurance companies are actually going to Jamaica and the Philippines. Why? Because it's a lot less expensive for them to set up a call center there. And some of them are competent and some of them are not. But these are some of the painful steps that the insurance companies have to take to be profitable. And in the long term, it's going to benefit all of us. As soon as rates one day, we hope, will stabilize. Okay, next slide. So I want to share a couple of real stories with you that happened just to me and my associations in the last, one in the last week and another one in the last year. I had a large association that I managed the insurance for in the East Bay. They were so large that it was $260 million in estimated replacement cost. Farmers decided they couldn't afford this type of risk, $250 million. I don't blame them from on one hand. But what happened was this association, who was relatively claim-free, had to go to the E&S, or the excess and surplus lines market. And guess what? The prices that you'll see out there are mercenary. Their premium with Farmers went from about $129,000 a year to about 451,000 a year. And that did not include the D&O or the fidelity or the workers' comp or the umbrella. Overall, I found out later the total cost was about $520,000 a year for their insurance, when previously it was only 129. So this is what's happening to a lot of big associations. The insurance companies have no appetite for that. In fact, this might be a good time for me to share. I have a good friend of mine who shared some information with me. And if I have it here in front of me, yeah, it looks like Farmers Insurance, which had a suspension on writing associations, will be writing them again on August the 1st. And what we're going to have some restrictions. They're only going to insure your association if it's less than 30 years of age or $25 million or less. Luckily, I represent a lot of different companies today, so we can go outside. But I think this is, well, I think it's just, I don't like it. Let me just put it bluntly like that. But that's what's happening. Travelers insurance, the same thing. No more than 25 million in replacement costs or no more than 30 years of age. Mercury Insurance, the Philadelphia Insurance Company, also have some hard rules in their underwriting. Oregon Mutual is another company. And Nationwide, they seem to jump in and jump out of the California market. I'm not sure what they're up to today. But that was one real story I wanted to share with you. Another one that just happened recently is Farmers had one of my associations here in the North Bay up for renewal. And the underwriters, they looked at the website of the management firm and saw that one of the board of directors, who was being smart and prudent and diligent, recommended that anybody who has a Zinsco panel to replace it. Well, that was enough for Farmers to issue a non-renewal to that association because they had Zinsco panels out there, obviously. Well, remarkably, and when I say remarkably, I really mean it. This board was smart and proactive. In the last 80 days, they installed 101 new panels and replaced the old dangerous Zinsco panels. So now Farmers Insurance is going to renew them, thank heaven. But it's a dramatic step that they had to take and very quickly as well. So these are some of the things that are happening. Another example is another HOA here in the North Bay had an old heritage tree fall down over the weekend. It was the biggest tree I've ever seen in my life fall down. The cost by the emergency response team just to cut the tree down and pull it away from the homes because it damaged 2 homes was $45,000. Oh my gosh, that is a lot of money. So real stories, that's it. Okay, next slide. Thank you, Connor. So the dreaded Zinsco panel, I won't go into too much detail here, but in the 1960s and 70s, this was the most popular electrical panel. It was popular because the Zinsberg brothers, who owned the company, developed a new breaker called the R38 twin circuit breaker. It was made of aluminum because the Vietnam War was eating up all the copper. And it was a great breaker at the time because it handled 2 circuits instead of 1, which freed up a lot more room on the electrical panel. However, it wasn't until 20 or 30 years later that a lot of fires started to occur. And next slide, Connor. There was a design flaw in this panel. The aluminum was cheap grade. So what happened when you had a power surge, it didn't trip the breaker. And the power continued to go and go and go until it caused a fire. Or some people, when they saw electrical disturbance, put their hand on it and they got shocked. So that's why the Zinsco panel is, if you have it in your association, get rid of it. We might even hear some more about this from some of our other agents in the industry today, but I wanted to mention that to you as well. Okay, next slide. By the way, GT Sylvania bought out the Zinsco brothers around 1970, 1980. I forget the exact year, but they rebranded their panels called the Challenger, for example, but it had the same R38 twin circuit breaker. So be careful about that. You should have an electrician come out and take a look at your panel. Okay, next slide. Let's see here. How are we doing on time, Connor?
Got 1 minute.
2 minutes left. That's quick.
Okay, there you go.
So I wanted to give everybody my crystal ball for next year, and believe me, it's a crystal ball. Who knows what's going to happen in our world today? But I'm hoping, and I think rates will stabilize next year. Why? Because the insurance companies have taken dramatic steps to increase their rates, which is more revenue for them. They've laid off their staff. They're starting to leverage technology a little better. And according to Swiss Re, which is, again, one of the largest reinsurance companies in the world, they're expecting a 98.5% property combined ratio which is really good. Anything under 100 means the insurance companies are making some money. Okay, next slide. Next slide, Connor. I think some of our other agents are going to address that issue. I got to make a quick plug for the Walls Out property policy. As many of you know, I've been recommending this for 2 years. You'll save, next slide, Connor. Walls Out means that the insurance company will pay for everything up to the sheetrock, including the sheetrock, but the homeowner has to pay for their kitchens and bathrooms and flooring and other fixtures on the inside. It's a great way to save 80% or 20% a year on your insurance. About 70% of the claims that I see are water claims inside a unit, toilet overflow and so on, and dishwasher. If you transfer the risk to the homeowner, that means you just mitigated 70% of your claims in the future. Another benefit of it. And then I also think it's fair. If a homeowner has a toilet overflow in their unit, let their HO6 policy pay for that. This way you protect your rates. So to finish up, in the next 5 years, I know rates aren't going to go down or backward. We all know that. They're only going to go up. So as you're going to hear from some other great agents today, write down a lot of notes, take these proactive steps, and then you can at least mitigate future insurance rates for you. Thanks, everybody. I appreciate your being here today, and thank you so much.
Great. Thanks, Kevin. Charlotte?